Hello and welcome to your daily note for January the 5th, 2023. So, today's daily note, we're going to cover the JOLTS job openings data as well as the ISM manufacturing PMI. And then we're going to dig into the FOMC minutes and talk a little bit about what the Fed discussed as they tried to arrive at their 50 basis point increase in December. I want to start with job openings, quits, and hires and the unemployment level, primarily because that leads us into data that's coming out today and later into the week. That's the ADP employment report, the initial jobless claims, as well as the unemployment report, labor force participation rate, and the labor data that's coming out later. Now, what you can see is that quits actually accelerated slightly, although it's still in a downward trend where it peaked in March. Job openings did continue to come down, but they actually held above 10 million. I thought that they would come in real close to that, coming in at 10.458 million. Hires and the unemployment level is basically the same at roughly 6 million people. So hirings have basically fallen off. That fits well with our Fed survey data saying that it's more of a hiring stall right now. There's very, very little change. And you're going to see that in just the report in general. They basically said little changed several times. I'm going to highlight it here. Job openings, little changed. Hires and total separations, changed little. Separation, quits, and layoffs, changed little. So we've talked about this using the Kansas City Fed employment index, but we are seeing the labor market lose momentum. So it's no longer quote unquote strong. It's starting to just hold, if that makes sense. You're going to see it when we talk about the FOMC. It's another thing that they highlight that there may be a situation where we're in this labor hoarding environment where firms are talking about short supply of labor because the labor force participation rate is still sluggish and hasn't recovered to pre-COVID levels. And these workers were so hard to find that it's hard for them to just lay them off, even though demand is slowing down. Now, that's what you're going to be seeing in the ISM report. So let's flip back over here. The ISM came in at 48.4 compared to the 48.5 forecasted and compared to the 49 prior. That is the second consecutive month in contractionary territory. They believe the break even was 48.7. We're below that 48.7. And so we definitely are in contractionary territory. In fact, if you come down and look, overall, they believe that the economy is contracting at a faster pace. There's only two things that accelerated in this report. That's employment and that's inventories. Inventories increased about 1% and employment increased about 3%, where you had new orders down 2%, and that index is at 45.2. Production was down 3% to 48.5. New export orders and imports were both down 2.2 and 1.5. And so you're seeing a broad theme. I've been talking about this, but the Fed survey data seems to lead the ISM report and seems to lead industrial production. And so with Fed survey data rolling over earlier in 2022, now that we're getting into 2023, we're now seeing that rollover actually hit the hard data here. I'm going to come down a little bit here just so you can see the reduction in like new orders, the slowdown in production, the flat line in employment. So again, echoing the fact that there's little change in the job openings, labor turnover rate, dropping in supplier delivery, elevated inventories, elevated customer inventories, falling prices, falling backlog of orders. I mean, this is still a very similar story to what we've been experiencing, again, in some of the other data that's coming through. This also just re-echoes and reaffirms that the economy is slowing, and it makes the Fed's job extremely difficult right now. How do you raise rates in the face of this slowing economic data that's very, very clear that your policy is working and that your interest rate is restrictive enough to slow down demand and to bring down prices broadly? I think they are starting to see some positive momentum there. I do want to highlight some respondents from both survey participants as well as Timothy Fior, the chair of the Institute for the IMS. So just a couple things here. I'm going to come down here and kind of hit this main highlight. The U.S. manufacturing sector again contracted, with the manufacturing PMI at its lowest level since the coronavirus pandemic recovery began, with Business Survey Committee panelists reporting softening new order rates over the previous 7 months. The December composite index reading reflects companies slowing their output. Demand eased, with the new orders index remaining in contractionary territory. New export orders index markedly below 50%. And customer inventory index in just right territory, and backlog of orders index recovering slightly but still in strong contraction. Output and consumption was neutral, with a combined 0 percentage point impact on the manufacturing PMI calculation. The employment index moved back into expansion, and the production index dropped into contractionary territory. Many panelist companies confirm that they are continuing to manage headcounts through a combination of hiring freezes, employee attrition, and layoffs. Inputs, defined as supplier deliveries, inventories, prices, and imports, accommodated future demand growth. The supplier delivery index indicated faster deliveries, and the inventory index expanded at a faster rate as panelist companies continued to effectively manage the total supply chain inventory. Again, with the fact that manufacturing has detracted after expanding for 29 straight months, panelist companies continue to judiciously manage hiring. The month-over-month performance of supplier deliveries was the best since March of 2009, and the average lead time remained 32% above the previous trough for capital expenditures and 37% for purchase materials. All of this just continues to point to a struggling manufacturing sector. It's less rate sensitive, but it's starting to spill over now from the housing market into manufacturing. So here's some of the respondents and what they're saying. Skilled labor shortages are huge, putting a lot of pressure on existing personnel. Orders are really slowing down in the original equipment sector. We haven't seen a major output decrease because we are still eating away at our back orders. Uh, Again, a sign of maybe some labor hoarding going on there. No reason to lay people off if you have some work to do. Customer demand continues to be depressed, while 2023 pipeline is looking very positive. Current demand is significantly down. The continued uncertainty in the economy has resulted in customers delaying their commitments for capital purchases, which is impacting our fourth quarter sales and lowering our forecast for the first quarter of 2023. Overall, supply chain conditions have stabilized tremendously since the fourth quarter of 2021. Issues remain, but the list is quite a bit shorter. Customer demand is very strong, and the outlook is positive for 23. There is a large focus on marginal recovery after this period of high inflation. So I think you're getting a general flavor of the sentiment out there. And again, that's why the ISM and Fed survey data are so interesting. They really are truly a sentiment report, and they kind of give us an idea of what the hard data like industrial production or durable goods orders or manufacturing new orders could be. And I expect the orders that are going to come out later in the week, tomorrow actually, I expect those to continue to come down, as well as when we get industrial production next week. I expect that to come down. So again, I think you're seeing a combination of confirming economic data. Over the last, call it 4 or 5 months, we've seen the Fed survey data fall, which is a leading indicator to maybe like the ISM falling. And now that the ISM is falling, we should see the hard data like manufacturing orders, durable goods orders, and industrial production fall. That is giving the Fed some very difficult ground to work off of. In fact, one of the things that I wanted to point out here is this tightrope that they're trying to walk. And inside of the FOMC minutes, I think they did a great job of outlining what that tightrope actually looks like. So many participants highlighted that the committee needed to continue to balance two risks. One risk was that an insufficient restrictive monetary policy could cause inflation to remain above the committee's target for longer than anticipating, leading to unanchored inflation expectations and eroding the purchasing power of households, especially for those already facing difficulty making ends meet. The other risk, however, was that the lagged effects of policy tightening could end up being more restrictive than is necessary to bring down inflation to 2%, and lead to an unnecessary reduction in economic activity, potentially placing the largest burden on the most vulnerable groups of the population. This also is a big reason why I believe the stock market is in a sideways consolidation. Yes, we can retest that low, but we're having trouble breaking through support and breaking through resistance right now. There's an equal weighted outcome to both of those risks. It's almost a 50-50 probability that we're going to get one or the other. And as we get confirmation data that one's going to happen over the other, you're then going to get the market to start to shake out which direction it goes next. Currently, I believe the Fed should pause. I don't think they should raise rates in February. But despite what I believe or think, when we look at panelists' expectations, here is what they're saying. In discussing the policy outlook, participants continued to anticipate that ongoing increases in the target range for the federal funds rate would be appropriate to achieve the committee's objectives. In determining the pace of future increases in the target range, participants judged that it would be appropriate to take into account the cumulative tightening of monetary policy, the lag with which monetary policy affects economic activity and inflation, and economic and financial developments. No participants anticipated that it would be appropriate to begin reducing the Fed funds rate in 2023. I'm going to say that again. No participants believed it was appropriate to reduce the Fed funds rate in 2023. Participants generally observed that a restrictive policy stance would be needed to maintain until the incoming data provided confidence that inflation was on a sustained downward path to 2%, which was likely going to take some time. So, despite the fact that I don't think the Fed should raise rates further from here, given that they are seeing plenty of confirmation that inflation's coming down, that the economy is slowing, they're going to err on the side of caution. They're going to keep raising rates to make sure the quote unquote job is done. Jerome Powell has used that language and he's used that conversation before. Now, the market and the economy might make the Fed blink, and that's kind of my base case, is that the Fed's going to raise rates until they get the outcome that they want. And that, of course, is going to put pressure on the market and it's going to put pressure on the economy. So, again, I think you continue to trend somewhat sideways here until we get that confirmation in February. But my base case is to continue to remain defensive from the perspective of a policy error that could occur. So, with that, I think that's a great place to stop. I recommend that you take some time and go look at the FOMC minutes. There's a lot of additional information in here. You see that I've kind of highlighted it like crazy to give me a lot of other review points or talking points as I'm helping you work through and navigate this economic cycle. But those were my key takeaways so far. Was that they expect to remain restrictive. They don't expect to cut interest rates in 2023, and they see two risks. They see a risk that they've not done enough, and they've also see a risk that they've done too much. That's definitely hedging their bets, and it's a great way for them to say that they don't know. They're not sure how restrictive they have gotten, and they're not sure the impact overall to the economy just yet. And so they need more data, and that's why, again, I think the market is moving sideways while the economy is rolling over. And I err on the side of caution when the economy is rolling over, and so we're just going to reiterate our defensive stance for the time being. So with that, if you have any questions at all, don't hesitate to leave those comments below or shoot us an email. We'll be happy to answer those for you. Stick with us. Again, tomorrow you're going to get a lot of employment data. You're going to get the average hourly earnings report. You're going to get non-farm payrolls, unemployment rate, labor force participation rate, as well as new orders. And today you're going to have Fed Bostic and Fed Bullard speaking that could also give us some indication to maybe what the Fed is thinking moving into February. So with that, we thank you. We hope everybody has a great Thursday, and we'll be back again tomorrow with another update.